Welcome to a deep dive into commodities trading. It's a world that most people don't think about too much, but it really impacts all of us.
Yeah, it's kind of hidden, but it touches everything.
Right, from the gas we put in our cars to even like the phones we use every day.
Exactly, exactly. And we're going to use this book, The Secret Club That Runs the World by Kate Kelly, to kind of pull back the curtain and see how it all works.
See how these billion-dollar bets and these power plays shape the prices of everything.
Because it really is a global game with some pretty high stakes.
Yeah, and some really interesting characters too, like this guy Pierre Underand.
Oh, yeah, Underand. What a story.
He was an Olympic swimmer, can you believe that?
Huh.
And then he becomes this oil trading prodigy, making and losing fortunes like it's crazy.
And Durand is a great example of how much psychology plays a role in this world. It's not just about the numbers, it's about understanding how people react to events, how fear and greed can drive the market.
It's like a high-stakes poker game, but with barrels of oil instead of chips.
Exactly. And then you've got these massive companies like Glencore. I mean, talk about operating in the shadows. They control so much of the world's raw materials, and they do it with incredible secrecy.
Yeah, Kelly calls them like masters of staying under the radar. Okay, so let's start with the basics. What exactly are we talking about when we say commodities? I mean, I think I know, but I bet there's some things that fall into that category that I wouldn't even think of.
That's true. It's a broader category than most people realize. We're basically talking about raw materials, the things that are the building blocks of the global economy. So, yeah, you've got your oil and gas, but it also includes things like the copper wiring in our homes, the corn and wheat that feed us,
Right. Yeah.
even like obscure elements like cerium.
Cerium, what's that?
It's used in a lot of everyday tech stuff, like the screen on your phone. You probably use cerium every day and never even knew it.
Wow, I had no idea. So it's really kind of everything when you break it down.
Pretty much. And trading these things, it's been going on forever. Think about it. For as long as there's been agriculture, there's been someone trying to make sure they get a good price for their crops.
Right, like supply and demand, that's always been a factor.
Exactly. Kelly talks about, imagine Sumerian farmers over 3,000 years ago making forward contracts. They'd agree to sell their future harvest at a set price. That's managing risk. That's ensuring income. And it's the same basic principle that drives commodity trading today.
That's amazing. So from like ancient farmers to Wall Street hedge funds, it's all kind of connected.
It really is. And of course, the scale and the complexity have evolved over time. But that fundamental idea of managing risk, securing a profit, it's a constant.
So how did we go from those farmers making deals in a field to these like global markets with like algorithms and high frequency trading and all of that?
Well, it's a long story, but the short version is that as the global economy grew, so did the need for sophisticated ways to buy, sell, and manage these essential raw materials. And that created opportunities for speculation, for people to bet on the future prices of these commodities.
And that's where things get really interesting, right?
Exactly, because now you've got hedge funds, banks, all these big players making huge bets on whether the price of oil or gold or soybeans is going to go up or down. And those bets can have a massive impact on the global economy.
Which brings us to this thing Kelly calls the commodity supercycle. It seems like everything was booming back then, especially like China and India. Their economies were growing like crazy.
Yeah, the super cycle was fueled by this incredible surge in demand, especially from those emerging markets. And it wasn't just demand. There was also this fear of scarcity. Everyone was talking about peak oil, like we were about to run out.
Right. It felt like a real turning point.
And it created a sense of urgency, almost a gold rush mentality. Everyone wanted to get in on the action. You had seasoned traders, of course, but also everyday investors piling into commodity index funds, thinking it was easy money.
Yeah, remember the Goldman Sachs Commodity Index, the GSCI? It was like the hot stock tip at every cocktail party.
Exactly. It seemed like a sure thing until 2008 happened.
The financial crisis, that was a wake-up call for a lot of people.
It was a brutal reality check for commodity markets. Prices plummeted, and a lot of people lost a lot of money. The GSCI, which had been soaring, took a nosedive.
So even when it seemed like everything was booming, there was always this underlying risk.
Always. It's important to remember that no market is immune to the forces of fear and greed. And when those forces take over, things can get pretty unpredictable.
So even as the world was kind of falling apart, you still had people making and losing fortunes trading commodities. And Kelly tells some really interesting stories about the people who were at the heart of this wild time. Like, let's talk about Pierre Andurand, the guy who went from the Olympics to, like, master of the oil market.
Andurand is fascinating. He wasn't just a numbers guy. He was obsessed with understanding market psychology, the things that drive traders' decisions.
Like reading people's minds.
In a way, yeah. He could seemingly sense shifts in the market before they happened. For example, he recognized early on that China's demand for oil was going to be a game changer, and he wasn't afraid to bet big on it.
So he was like a visionary. He saw the future.
He had a knack for spotting patterns that others missed. For example, he realized that a lot of oil traders underestimated how long it takes to bring new oil supplies online. So even when prices spiked, he knew the shortage would probably last a while, which meant prices would stay high.
So it wasn't magic. It was analysis and, like you said, understanding how people react.
Exactly. But even Andurand, who was so successful, wasn't invincible. When the 2008 crisis hit, his huge bets on oil backfired. His hedge fund, Blue Gold, nearly went under, and he had to close it down to avoid a total collapse.
What a story. It's like a reminder that even the best, even the smartest, can get caught up in the chaos.
Absolutely. No one is immune to the risks inherent in this market. And that brings us to a different kind of player, the institutional giants, like Glencore, this company that Kelly describes as shrouded in secrecy.
Yeah, this is where things get kind of, I don't know, cloak and dagger-ish.
Right. Glencore is a fascinating case study, founded by this guy, Mark Rich, who is actually quite controversial. They're involved in everything mining, shipping, you name it, operating in some of the most politically sensitive areas in the world. And they're masters at staying under the radar, often operating through a web of subsidiaries and shell companies.
So it's hard to even know what they're up to half the time.
Exactly. And that's led to accusations of, well, everything from tax evasion to environmental violations. It can be hard to separate fact from fiction with them.
So they sound a little bit scary, to be honest.
They definitely have a reputation, but even a giant like Glencore wasn't immune to the 2008 crisis. They faced a credit crunch, lenders suddenly got cold feet about doing business with them, even their relationship with BP, which had been rock solid, started to fray. They had to sell off assets, renegotiate deals just to stay afloat.
So even with all their power and secrecy, they were vulnerable.
They were. And that's a good reminder that everyone is connected in this global economy, even the companies that try to stay hidden.
Okay, so we've got these hedge fund guys making big bets and these huge multinational firms like Glencore pulling strings behind the scenes. But what about, like, the regular financial institutions, the banks? Where do they fit into all of this?
The investment banks. They're kind of like referees in a way, but they're also playing the game themselves. They're fascinating because they play both sides.
I'm not sure I follow.
So on one hand, they provide these essential services to companies that rely on commodities, helping them manage their price risk through things like hedging.
Right, so they're helping companies protect themselves from the volatility.
Exactly. But at the same time, they're also engaging in speculative trading for their own accounts, potentially profiting from that same volatility. It's like they're wearing two hats.
It sounds a little conflicted.
It can be. And in the wake of the 2008 crisis, there were a lot of accusations thrown around. People were saying banks were manipulating markets, putting their own profits ahead of their clients, even contributing to the crisis itself.
Yeah, I remember that. There was a lot of anger directed at Wall Street.
There was. And it's important to remember that behind all these big institutions and complex transactions, there are real people making decisions with real consequences. Kelly tells a great story about Jennifer Fan, who started at Morgan Stanley when she was just 20 years old.
Wow, 20. That's like barely out of college.
Right. She was this math prodigy who found herself thrust into this world of high-stakes commodity trading. And during Hurricane Katrina, she made a $3 million bet on gasoline prices, anticipating that refineries would be disrupted. It was a bold move for someone so young, and it paid off big time.
So she was a natural.
It seemed that way. But her story also kind of makes you wonder about the downsides of that kind of talent. Like, she was brilliant at analyzing the market, but was she really thinking about the bigger picture? The human cost of that bet, what those higher gas prices meant for people who were already struggling after a devastating hurricane.
Right. It's easy to get caught up in the game of it all and forget that these trades have real-world consequences.
Exactly. And Morgan Stanley itself wasn't immune to these ethical challenges. They made some really complex and risky trades with Emirates Airline, which is a huge buyer of jet fuel. These were supposed to be hedging strategies to help Emirates save money, but when oil prices went crazy, the bets backfired, and it cost them a fortune.
So even with all their expertise, they couldn't control the market.
Right. And that brings us to the regulators, the people who are supposed to bring some order to this sometimes chaotic world. In the U.S., that's the job of the Commodity Futures Trading Commission, the CFTC.
So they're the ones who, like, set the rules and make sure everyone's playing fair.
That's the idea, but their story is a long and complicated one. They've often been outmatched by the very firms they're supposed to be regulating, especially in the years leading up to the 2008 crisis.
So they were trying to keep up with an industry that was moving faster than they were?
Yeah, they were often one step behind. They just didn't have the resources or the authority to really rein in the excesses of the market.
But then the 2008 crisis happened, and that changed everything, right?
It did. The crisis exposed just how vulnerable the system was, and there was a lot of public pressure to do something about it.
And that led to the Dodd-Frank Act, right? That was a big deal.
Yeah, Dodd-Frank was a game changer. It gave the CFTC more power, more resources, and a broader mandate to oversee the derivatives market, which includes all these complex instruments tied to commodities.
So the government was basically saying, okay, we're taking this seriously now.
Exactly. And that shift in attitude, the increased regulatory scrutiny, it had a ripple effect throughout the entire commodities market.
So we've got these newly empowered regulators ready to, like, take on Wall Street. But at the same time, it seems like investors are starting to have second thoughts about commodities. Like, the bloom is off the rose.
Yeah, by the early 2010s, that commodity supercycle, it was definitely losing its shine. The Goldman Sachs Commodity Index, the one everyone had been piling into, it was basically flatlining.
And some of those hedge funds that had made a killing, they were, like, closing up shop, right? Like, they couldn't keep the magic going.
Exactly. A lot of them were struggling to replicate their past success.
So was it just, like, market fatigue? Or were there other things going on that were driving investors away from commodities?
It was a few things, I think. For one, the Fed was, pumping money into the economy, and that made stocks a much more attractive bet.
Right. Everyone was chasing those rising stock prices.
Exactly. And then there were the scandals. Those really shook people's confidence.
Yeah, like Peregrine Financial Group, MF Global. Those were big stories.
Huge. And they raised serious questions about, like, the security of customer funds, the integrity of the whole system.
Right. It was like, wait, if these big firms can just collapse, what does that mean for the rest of us?
Exactly. And that just added fuel to the fire that was already burning, with Dodd-Frank and all the talk of regulatory reform.
It was like a perfect storm. Underperforming markets, high-profile scandals, and this, like, crackdown by regulators. No wonder some of the big players started heading for the exits.
Right. And you saw banks like J.P. Morgan, Morgan Stanley, they started selling off their physical commodities assets, scaling back their trading operations. It felt like the end of an era, like the Wild West days of the supercycle were over.
But even as some people were running for the hills, others saw opportunity, right? Like Delta Airlines. They decided this was the perfect time to jump into the game.
Yeah, Delta's an interesting case. They hired this guy, John Ruggles, a former Wall Street trader, to run their fuel hedging program.
And he was a bit of a maverick, right? Like, not afraid to shake things up.
He was. He came from that high-stakes world of Wall Street where taking big risks was rewarded. He thought airlines needed to be more sophisticated, use the same kind of strategies as hedge funds to manage their fuel costs.
But Delta wasn't exactly known for being, like, a risk taker, were they?
Not really. They had this very conservative culture when it came to financial management. So Ruggles' approach, his whole style, it kind of clashed with that.
So how did he manage to convince them to let him, like, loose on their fuel hedging program?
He made a pretty compelling argument. He said, look, in a volatile market like this, just buying fuel on the spot market is like playing roulette.
You're just at the mercy of the market.
Exactly. He said hedging using financial instruments like options and swaps that allows you to lock in favorable prices, protect yourself from sudden price spikes.
Okay, so can you break that down for us a little? Like, what are options and swaps, and how do they work in the context of, managing fuel costs?
Sure. Imagine you're worried about the price of milk going up, Frank.
Okay, I can relate to that.
So an option is like buying the right, but not the obligation to buy milk at a certain price in the future.
So you're kind of, like, betting on whether the price will go up or down.
In a way, yeah. If the price goes up, you exercise your option and you buy at the lower price. If it goes down, you just let it expire and buy milk at the market price.
Makes sense. What about swaps?
A swap is a little more complicated, but basically it's an agreement to exchange future cash flows based on the price of, in this case, milk. So like Delta might agree to pay a fixed price for fuel in the future, even if the market price goes up.
So it gives them certainty, like they know what their costs are going to be.
Exactly. It's about mitigating risk, creating predictability in a market that's known for being unpredictable. And for a while, it worked really well. Ruggles' program was saving Delta a lot of money, especially in those years leading up to the 2008 crisis. He was like a hero. People called him a Wall Street wizard.
So everything's coming up roses. But this is Wall Street we're talking about. I have a feeling this isn't the end of the story.
You're right. It's never that simple. The 2008 crisis, it kind of exposed the flaws in even the most sophisticated hedging strategies, and Delta wasn't immune. And as the pressure mounted, cracks started to appear in Ruggles' perfect facade.
So what happened? Did he, make some bad bets?
Yeah.
Or was there more to it than that?
That's what's so interesting about this story. It wasn't just about market forces, it was about human nature. Ruggles, he was brilliant, no doubt, but he also had this weakness, greed.
Uh-oh.
He saw an opportunity to profit, not just from managing Delta's fuel costs, but from trading for his own personal account.
Wait, so he was, betting against Delta?
Essentially, yeah. He was using what he knew about Delta's hedging strategy to make side bets in the market. A huge conflict of interest.
And I'm guessing this didn't end well. How did Delta find out what he was doing?
It all unraveled when the CFTC, those regulators we were talking about, they started investigating some suspicious trading activity. They were looking into the oil markets, and they quickly zeroed in on Ruggles.
They were on the case.
They were. And what they found was that he was making trades in his personal account that mirrored Delta's hedging strategy.
Huh.
He was basically front-running their moves in the market.
So it wasn't just unethical, it was illegal.
Exactly. Insider trading, plain and simple.
Yikes. So what happened to him? And what about Delta?
The CFTC charged Ruggles with insider trading, and Delta got hit too. They were accused of, failing to supervise him, failing to prevent this conflict of interest.
So it was a mess for everyone involved.
It was. And it wasn't just a slap on the wrist either. Delta ended up paying a hefty fine to the CFTC, and they had to implement all these new compliance measures to make sure it wouldn't happen again.
What about Ruggles? Did he go to jail?
He fought the charges hard. He said he was just using publicly available information, not insider knowledge. But the CFTC, they weren't buying it. They had emails, trading records, all this evidence that showed a clear pattern of illegal activity.
So it was a classic case of greed getting the better of someone. He had it all a great job, a reputation, but it wasn't enough.
Yeah, it's a cautionary tale about the temptations in this world, how even the smartest people can make really dumb mistakes when they let greed take over.
And it shows how important it is to have a strong ethical compass, right?
Yeah.
In a market where there's so much money at stake, it's easy to lose sight of what's right and wrong.
Absolutely. And that kind of brings us to a bigger question. What's the future of commodities trading after all of this? After the boom and bust, the reforms, the scandals?
Yeah, where do we go from here? We've seen how this market has evolved from those ancient Sumerian farmers to the high-frequency algorithms that are used today. But what's next?
That's the million-dollar question. And it's one we're going to explore in the final part of our deep dive. We'll look at the forces that are shaping the future of this fascinating and often controversial market.
So we've covered a lot of ground here. We've talked about the history of commodities, the big players, the scandals, the regulations.
Yeah, it's a wild world, that's for sure.
It is. But as we wrap up this deep dive, the big question is, what's next? What does the future hold for commodities trading?
Well, the commodity supercycle, that's definitely over. We're in a new phase now. Slower growth, more volatility, and a lot more scrutiny from regulators.
So what's driving this new landscape? What are the big trends we need to be paying attention to?
I think one of the most significant trends is the growing influence of these emerging markets, especially China and India.
Yeah, we touched on that earlier, but I'd love to dig a little deeper. How has their rise changed the game for commodities trading?
It's been huge. I mean, in the past, commodity markets were mostly dominated by developed economies, right?
Right.
But now the balance of power has shifted. China, for example, they're the world's biggest consumer of a lot of key commodities now. Their demand for raw materials has had a ripple effect on markets everywhere.
So their decisions, their economic policies, those have a big impact on prices.
Absolutely. And it's not just about how much they're consuming, it's also about how they're going about getting those resources. Like, China has been investing heavily in mining and energy projects all over the world.
So they aren't just playing the market, they're trying to control it.
In a way, yeah. And that creates both opportunities and challenges for everyone else. On the one hand, there's this huge potential market if you can supply them with what they need.
Right.
But it also means more competition, and you have to adapt to their way of doing things.
So it's not just about understanding economics anymore, it's about geopolitics too.
Exactly. You got to understand the strategic interests of these emerging powers. The days of just buying and selling based on supply and demand, those are gone. You have to factor in all these other things now, like resource nationalism, trade agreements, even the potential for conflict over scarce resources.
So it's a lot more complicated than it used to be.
Way more complicated. And then you layer on top of that the impact of technology, which is transforming everything.
Yet tech has disrupted pretty much every industry. Commodities trading can't be any different.
Exactly. We're seeing it in a bunch of different ways. Like, there's the rise of algorithmic trading.
Where computers are making the trades.
Right. Super sophisticated algorithms that execute trades in, like, milliseconds.
Wow.
It's made the market more efficient, but it's also made it more volatile. And then there's the whole world of big data and analytics.
So traders are using, like, massive amounts of data to try to find an edge.
Exactly. Everything from satellite imagery to social media trends. It's like Moneyball for commodities.
That's kind of mind-blowing.
And this is just the beginning. I mean, we're just starting to see the potential of things like blockchain and artificial intelligence. Who knows how those will change the game?
So it feels like we're entering this whole new era of commodities trading.
I think we are. It's more complex, more data-driven, more global.
And more risky.
Probably. But also potentially more rewarding for those who can figure it out.
So, like, where does that leave the average investor, the person who's not a hedge fund manager or a CEO? Is there still a place for them in this market?
That's a good question. Commodities have always been a risky investment, and that's even more true now.
Right.
But I do think there are still opportunities for people who do their research, understand the risks, and importantly, have a long-term perspective.
So it's not for the faint of heart.
Definitely not.
Yeah.
But it can be a way to diversify a portfolio, maybe benefit from some of those global growth trends.
So as we wrap things up here, I think it's safe to say that the world of commodities trading, it's not going away, but it's definitely changing.
It's more dynamic than ever, and it's going to continue to impact all of our lives, whether we're paying attention to it or not.
Well, hopefully this deep dive has inspired some people to start paying attention.
I hope so. Because the more we understand about this market, the better decisions we can make.
Well said. It's been great exploring this world with you.
Likewise. Until next time, keep learning, keep questioning, and keep diving deep.
And thanks to all of you for joining us on this deep dive into the world of commodities trading. We'll see you next time.